Since Trump's victory earlier this month, the dollar has surged as investors anticipate that his proposed tariffs and tax cuts will strengthen its value. While this might seem like positive news, Trump and his vice president, Vance, actually campaigned on the idea of a weaker dollar, hoping it would revitalize America's manufacturing sector. In this video, we'll explore why Trump advocates for a weaker dollar and how he might attempt to devalue the world's reserve currency. Let's begin by examining Trump's statements. His most recent explicit remarks on the topic came in late July during a Bloomberg interview, where he described the dollar's strength particularly against the yen and the yuan as a big currency problem. This concern isn't new for Trump. Throughout his first term, he repeatedly argued that the dollar was overvalued and pressured the Federal Reserve to cut interest rates to lower its value. J.D. Vance has echoed similar views. Last year, during a questioning session with Federal Reserve Chair Jerome Powell, Vance suggested that the dollar is fundamentally overvalued. In an April interview with Politico, he explained that devaluation, while it sounds alarming, would make American exports more affordable and competitive. To be fair, there is a broad consensus that the dollar is indeed overvalued. The IMF estimates it is about 10% higher than it should be. Over the past 2 decades, the broad dollar index has risen by 25%, despite the U.S. running significant trade deficits, meaning it imports more than it exports, which typically would weaken a currency. The primary reason for the dollar's overvaluation is its status as the world's reserve currency. Central banks and financial institutions worldwide hold dollars because of their perceived safety, creating strong international demand and inflating its value artificially. So, why does Trump want to devalue the dollar? At first glance, having an overvalued currency seems advantageous. It allows a country to import more goods at lower costs, and America's adversaries, including Russia and China, often criticize this benefit. Additionally, the dollar's status as the world's reserve currency enables the U.S. to impose powerful financial sanctions unilaterally. However, while there are clear benefits, many commentators have begun questioning whether this is actually detrimental. The primary drawback is that an overvalued currency makes U.S. exports less competitive on the global market. This is particularly damaging to the manufacturing sector, which struggles to compete against cheaper imports. Both Trump and J.D. Vance have highlighted this issue. In a Bloomberg interview, Trump stated that manufacturers find it difficult to sell products abroad because they are too expensive. Vance has described the dollar's reserve status as a massive tax on American producers. Today, there is growing consensus that the dollar's reserve status has contributed to the deindustrialization of the U.S. economy. As politicians focus more on rebuilding American manufacturing, they have begun to question whether maintaining this reserve status is beneficial. Many also attribute China's economic success to its strategy of deliberately devaluing its currency, which keeps its exports competitive and shields its industrial base. Meanwhile, other countries are pushing back against the dollar's dominance, particularly as the U.S. has increasingly used financial sanctions. So, can Trump actually devalue the dollar? Before exploring how he might do it, it's important to note that many of his other economic policies would likely strengthen the dollar. For example, his proposed tariffs could raise inflation, prompting the Federal Reserve to increase interest rates. Higher interest rates make the currency more attractive to investors, further strengthening the dollar. Proposed tax cuts would also fuel inflation by boosting disposable income. Additionally, countries like China might respond to U.S. tariffs by devaluing their currencies, which would indirectly push up the value of the dollar since its worth is relative to other currencies. This dynamic explains why the dollar appreciated after Trump's victory, as investors anticipated high tariffs and a stronger dollar. Trump has made it clear that he wants to maintain the dollar's status as the world's reserve currency. He has even threatened to impose 100% tariffs on countries that leave the dollar and told the Economic Club of New York that losing the dollar's global dominance would be like losing a war. Based on this analysis, protecting or reinforcing the dollar's reserve status would likely lead to a stronger, not weaker, currency. Even if Trump abandoned these policies or if they didn't have the expected effects, actively weakening the dollar would still be challenging. In theory, devaluing a currency seems simple, Just print more money and use it to buy foreign currencies. However, the Federal Reserve, as the central bank, is the only institution that can print dollars, and it operates independently. The president cannot directly dictate its actions. There are, however, 4 possible ways Trump could try to force a devaluation. 1. Pressure the Federal Reserve. He could attempt to influence the Fed to cut interest rates or intervene in currency markets. However, undermining the Fed's perceived independence could destabilize financial markets. 2. Direct government intervention. The government could enter currency markets directly, buying foreign currencies to weaken the dollar. This approach would likely require borrowing and spending trillions of dollars. 3. Implement capital controls. These measures would limit how many dollar-based assets foreigners can buy or impose taxes on such assets. While this could weaken the dollar, it would also undermine its reserve status and signal a major shift away from the US's traditionally open financial system. 4. Negotiate an international agreement. The most feasible option might be to negotiate a deal similar to the 1985 Plaza Accord, where the US and major trading partners, France, West Germany, Japan, and the UK, coordinated to lower the dollar's value. This involved other countries boosting domestic demand while the US reduced its own. However, replicating this today would be more challenging due to larger global currency flows and complex relationships with countries like China. The Plaza Accord was successful at the time, but replicating a similar agreement today would be far more challenging. Currency flows are now significantly larger, making them harder to influence. Additionally, America's main trading partners are no longer exclusively its allies, and reaching a currency deal with countries like China could prove particularly difficult. Thanks for watching. If you found this video insightful, don't forget to like, share, and subscribe for more deep dives into global power dynamics. What are your thoughts on today's content? Drop in the comments below. See you in the next one. Thank you for watching.